It's October 2008, and the US economy is on the precipice of a recession that some warned would rival the Great Depression.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The fact was we were experiencing a financial panic. And the only way to stop a financial panic is to show people there is no need for one.
Congress had just passed the Troubled Asset Relief Program, known as TARP, with the intention of stabilizing the US financial system. Hank Paulson, US Secretary of the Treasury, revealed one way they would do this. The government would provide capital to the nation's largest banks, billions in cash, so consumers would trust the banks would not fail as a result of the unstable economy.
It was an extremely stressful time, but I wanted to help and I had the opportunity to do so.
Timothy Massad was in charge of the TARP program under the Obama administration.
There was a lot of cooperation between the outgoing Republican administration and the incoming Democratic administration with respect to TARP. It was not a partisan operation.
Dick Kovacevic, then chairman of the board at Wells Fargo, receives a phone call from Hank Paulson.
I got a phone call on Sunday night from Hank Paulson saying he wanted me to be in Washington the next day.
Kovacevic flew back to Washington and found himself in a conference room at the Treasury Building, with the heads of the 9 largest banks in America on one side of the table. On the other, the government representatives from the Treasury, the Federal Reserve, and the FDIC.
And that's when the discussion on TARP started and ended.
The TARP program invested around $250 billion in hundreds of banks, but it started with the 9 gathered in that room, and not all the banks wanted the money.
They came to Wells Fargo, me, and said, we want to give you $25 billion. And I said, we don't need $25 billion. We have enough capital so that we can go through this thing and lend money, etc. They said, if you don't take the money, they're talking to me, I'm talking to them. No one else had any conversation about it. Hank said, your chief regulator is sitting here right next to me. If you don't take the money, we're going to declare you capital deficient on Monday morning.
For Wells Fargo, this would jeopardize their upcoming acquisition of Wachovia Bank.
I assumed that if I was capital deficient, you can't acquire, and so they gave me a proposition that I couldn't refuse.
Ben Bernanke, an economist who served as the chairman of the Federal Reserve from 2006 to 2014, believed the only way to ensure the success of the TARP program was to require the healthy banks to participate.
And he just thought, well, we got to get the healthy banks, or otherwise there are going to be really bad runs on the unhealthy banks. And the big banks were the ones that had the biggest problems, that had made the stupidest mistakes, and they wanted to ignore the rest of the banking industry. There were very few mid-sized banks in trouble, very few.
Now, the government loans weren't free. The banks had to pay them back with interest.
But I think it would cost us $100 million that we absolutely did not need to pay. And we were just subsidizing the failing banks.
I wasn't in the room when the meeting was held with the 9 largest banks, and I would say the crisis we were in was unlike anything anyone had seen. For a bank to say, I didn't really need the money, again, I think it was hard to know how the crisis would unfold, and had we not done what we did, the crisis would have been far worse.
We accepted $25 billion we didn't want. We had to pay back the government $4 billion in interest and warrants within a year for money we didn't want and didn't need.
I think to get those big banks to accept the funds, and some of them claimed they didn't need the money, and there was certainly pressure put on them by the Bush administration because the concern was that these banks didn't really appreciate how bad this crisis was. They didn't appreciate that their health depended on the health of the system. And we had to get ahead of it. And I think the Bush administration and then Secretary Paulson made the right decisions in terms of that.
Mr. Kovacevic and Mr. Allison felt like they had been threatened by the government, a sort of regulatory ultimatum.
There was an enormous amount of coercion. We were one of the victims of it.
Fighting the Fed or a regulator, is not in your long-term best interest.
In their experience, this sort of intervention is nothing new.
Regulators use force all the time. It's subtle. They often attack in different ways. If they want you to do A, they tell you they want you to do A, but they don't try to make you do A, but they do tell you they'll do B. And you can't do a doodle-doddle about B unless you do A.
They just make it very difficult for you so that you voluntarily to do something you don't want to do. They're very clever in how they do that, and that's the way it is.
But did the government take it too far this time? Or did desperate times call for desperate measures?
It doesn't surprise me that a bank CEO would say that his or her bank didn't need the money and could have survived without it. Frankly, to admit that you need capital would be to invite a run. But I don't think any CEO can be confident they could have survived without this program. No bank exists in isolation, and each is part of the financial system, and its health is dependent on the health of that system. And, when you have a widespread panic that is creating a widespread financial crisis, then every bank is vulnerable to a run. And that was the situation we had. And it was very hard to foresee at that point what was going to happen.
So, was the government right in this assessment? The success of the TARP program is still debated today, with more than 10 years of hindsight.
I'm not clear at all that forcing the healthy banks to participate was good. They had to let some of these big banks fail, and that would have been good. As long as they let the FDIC take them over, liquidate their bad assets, and then either return the company to the marketplace or break them up and liquidate them. If they broke them up and liquidate them, the world would be a better place today. Because what happened out of TARP, the regulators never really let go of the banks that they helped. And what that did was slow economic growth for years. And that slowing was absolutely unnecessary.
In my 40 years in banking, the regulators are always rescuing financial institutions from going bankrupt when they shouldn't. They let industrial companies go bankrupt all the time, but when it comes to banking, they rescue them. In my opinion, the reason they rescue them is to hide the fact that the regulator was not doing their job.
Mr. Kovacevic explained that when Secretary Paulson asked him to take the government's money, he refused, not only because Wells Fargo didn't need the money, but also because he believed it was a bad decision for the economy and the country.
I said, I want to be sure I understand this. Wells Fargo is the only AAA rated bank in this room. You're telling me that if you give me $25 billion that I don't want or need, that this is going to lift all the boats in the industry and we're going to be stronger as a result. Is that right? Right. I said, I disagree. I think the opposite is going to happen. I think the market is going to react very negatively to this, because if Wells Fargo needs $25 billion, that means that the industry is really in trouble, and it's going to react in a negative fashion. And as I said before, the stock market within a couple of weeks went down 40%. All bank stocks went down 80%. Interest rates went way up. You couldn't access the bond market. And they said TARP saved the world.
I think the impact of the TARP program was that it dramatically helped stabilize the financial system. To me, the proof that it was the right call was what happened to bank credit default swap rates immediately after that October meeting. CDS rates are basically a measure of whether people think a bank is vulnerable to failing. And the higher the rate, the more risk they perceive. And those rates shot up very, very dramatically in September of 2008, but then came down very quickly after that meeting. And another similar measure is the LIBOR OIS spread, which is the difference between the rate at which banks lend to one another and what's called a risk-free rate. And that rate also went up very quickly in September, and then came down very quickly. I know Jamie Dimon, the chairman and CEO of JP Morgan, said in his shareholders letter that they believed they were doing the right thing. Brian Moynihan, Bank of America CEO, similarly said that TARP was an important step to restore confidence in the system. And the head of Goldman Sachs also said TARP was important for financial stability. So you had a number of the top bank CEOs endorsing the program. I would say that overall, the TARP program helped stabilize the system, strengthen banks, and the reforms implemented after went a long way towards strengthening the financial sector.
Both sides on this issue have described TARP as aggressive. Bernanke himself said this in a recent conference at Brookings.
We did respond aggressively to the crisis itself and did bring it under control pretty quickly.
Some believe this aggressiveness saved the economy. Others believe it was crippling and started us on a path of excessive government intervention in the financial markets.
So regulators have always had the power to say that a bank needed more capital. And that's essentially the authority that was invoked in October of 2008. Now, it was obviously invoked in an extraordinary way, but these were extraordinary times.
What do you think?